No.
All right, sounds good. Welcome. Hey, everybody. Sorry, just ran from my trading computer over here. I want to get a few things set up, but have a good presentation. I've known Dave for a long time. So thanks for having us. And I think there's a lot to talk about in this market here. So as I said, just a quick run over to this to this computer, show you some live positions. Look at the market. I'm watching Nvidia knock on the highs. I have some live trades going on. I'll show you those in time. But yeah, just let me know. How's everyone doing? What's up? I know you've had a lot of content, and I'm going to bring an options angle to you if that's okay. And I'll see if I can watch your responses. But if you are trading options, if you're newer, if you're experienced, let's go scale 1 to 5. If you are new to options, considering it, maybe paper trading, or 5 if you are seasoned pro, maybe just looking to pick up the last few items. And I'll be watching these responses. So kind of helps me gauge, the level of the crowd here, and maybe customize it a little bit. So 1, you're a newbie. 5, you're pretty badass and you're just looking to pick up a few more things. And, a lot of people will be somewhere in the middle, but all is fine. All is fine. A couple 4s, a few brave ones. I appreciate that. Nice, nice, nice. Okay. Sounds good. So, pardon me, take a second to settle in here. That was a quick move for my trading computer over here to get things set up properly. But let's get into it. This is going to be the way I look at it is like a 2-phase option progression presentation. Real quick, if you don't know who I am, I'm Todd Gordon, and I have a research business called TradeOutLoud.com. I was founded in 2012. I'm also, I own a wealth management business that was launched in October of 21 called Inside Edge Capital. So we're active management of portfolios, and we have full-time sort of financial planner on staff. He's like my partner, but I kind of report to him on that end. So we full service wealth management business that I put the strategies to work that I teach on the research business. So we're one of the I guess I'm one of the few guys that has a research business and a wealth management business. I trade real money all the time. I've been doing it I've been trading since right out of college, which should be down there somewhere, down at St. Lawrence University a long time ago. I've been doing CNBC since 2010. I've probably been on, I don't know, 300, 400, 500 times. My last job was on Wall Street as a trader for a hedge fund, Gain Capital Asset Management, and that was back in 2010. I was also serving a dual role. I was also the senior tech analyst writing the daily research report. Prior to that, I prop traded and worked for a little CTA and hedge fund research firm in LA and San Diego. That was in 2001 to 5. And then, as I mentioned, a long time ago, I was in college, focused on, probably in this order, ski racing. I was trading options out of my dorm room and stock. I would say class and social life were probably on par, and it was great. I actually just got invited back to speak to the students at St. Lawrence University. One of my actually clients is a economics professor, what I majored in. So I was just up there 2 months ago, spent all day speaking to the finance and economics classes. So that's me real quick. So here's what we'll cover. Before we jump into setups and, buy here, sell here, and indicators to use and all that, like, I like to talk a little bit about, your trading personality. And I think mindset is just as important as when to buy and sell. And don't worry, we'll get to that. But if you just hang with me, I'd like to talk about your personality, then get into this 2-phase option progression, live setups. And as I said, I'm watching Nvidia. Can I put a buy, like a stop loss order in with you guys? Like, would somebody yell at me if Nvidia goes 707 bid, please? Like, it's like leaving a call with the trade desk, like, hey, give me a call if this price trades, because we got to make some moves if it does. And then I'll show you if you'd like to, I'll make a small offer for you at the end. And if you'd like to learn more about what, our approach to the markets. So, those of you who are like ones, twos, or actually even threes or fours, if you're on your way, when you first started out, or if you're just starting out, did you expect your P&L curve to be, just looking like the Nvidia chart, from the bottom left to the top right? Maybe it looks like the Tesla chart, which is like top left to the bottom right, which is a bummer, or maybe sort of a mess. And I think, from an options point of view, I think there's three reasons that newer traders have a hard time trading options. And these are the three, and we'll hit all three. So, I've seen, options educators, when you look at their trading platforms, like they have positions everywhere, like 30, 40, 50 positions open. You're like, what's your theme? Like, what are you trying to trade? Like, what are you doing? What's your core thesis? Are you bullish the market? Are you bearish the market? Are you, do you think we're in a range bound market? So does it look like the Matrix? I kind of call that spray and pray. The other reason I see people have a hard time is the pennies in front of the steamroller. It's really attractive to sell way out of the money credit spreads, picking up a couple nickels or dimes, risking $5 and $10 on the spread, which, works a lot of times, but that 18th or 19th or 30th time, it doesn't. You undo all that hard work, that you just did. The third reason, and this is sort of a fun, dramatic example, but the wrong horse. There's so many stocks to trade out there. And, this is sort of in a post-meme bubble environment. I was talking about Bed Bath & Beyond ahead of earnings on CNBC. And I was like, I wouldn't touch this thing because there was a new activist investor, Ryan Cohen, when he went in on Bed Bath & Beyond. And I was like, don't touch this. You don't know what he's doing. And I got skewered on the Reddit boards. And none of this is safe for work. So if you have sensitive eyes or ears, don't read any of this stuff. But I was like, don't touch it. Unless you're really on the inside of these activist sort of positions and meme stocks, you don't know what's going on. Well, he wound up taking a position, selling into the retail buying, like he screwed so many people, and people told me to basically go crawl in a hole and die on Reddit, but I was just trying to help him. Anyways, sort of a dramatic example. There's some crazy stocks out there, and if you don't have an idea what's going on, then that could be another reason that you may be not really hitting your stride. So this was, I thought, a really interesting article related to that during the pandemic. Meme stocks explode in popularity, and there's a few highlights in here. Retail investors are focused on cheaper weekly short-term options with high leverage. They're using them for high betting. We estimate that since the start of the pandemic, retail investors lost $2 billion in option trading. And again, they focus on risky short-term contracts. There's a potential to win big, but the chances are very low. It's like buying a lottery ticket. And this comes from the London Business School, which, take that as you will, but, I'm sure they did some research in this one. And, judging what we saw with, the crazy stocks, and meme has kind of calmed down a little bit. But, I think you got to have an understanding of what stock you're trading. And even if you apply the perfect technical setup and you put on the right option strategy, if you're not backing the right horse, you could be doomed before you even get started, right? So you've got to know what stock and what kind of stock you want to trade and what kind of market. That's an important part to being an option trader. All right, so let's get into it. Game plan number one. So this is literally handed down from ancient Greece, how to trade options. Know thyself, know your stock, know your strategy. Okay, so a little bit more on the psychological side. So just hang with me if you can. So we become cavemen when we trade, and cave women. So my job, I think, as I've been only doing this 20 years, which I'm still learning, I'll never stop learning. I kind of think of myself as Dean Warmer here in Animal House. And I'm like saying to a lot of you guys, I'm not talking to everyone. I'm just having fun with this, but it's kind of like, calm down, Animal House. Let's get a plan here. Let's understand what we're trying to do. Let's get serious. Let's, stop high fly trading, putting on positions where, you only have 13% chance of success and you have no idea what your contingency plan is and putting way too much money in, like, party's over. Let's get serious. And I'm having fun. I'm not being condescending at all, but there's some people I've worked with who it's like Delta House. Anyways, so back to the caveman tendency, right? When we are accomplished traders, we realize that you don't want to focus your energy on trying to figure out what the market is going to do tomorrow, next week, or next month. You want to focus on fully assessing the now. You want to make sure your process is dialed in. You know yourself. You know your tendencies. You know what kind of trader you are, what kind of person you are. And I feel like I have arrived as a trader and I feel confident where I finally launched my wealth management business, because I know that you can't know everything there is about the markets and smart enough to foretell what's going to happen in the future. What you can know is you can know yourself and you can know your tendencies. You can know what your reaction will be if you follow your plan well, if you veer off your plan, how are you going to handle that? It's knowing yourself. And that's EQ, emotional intelligence. Good trading is not about IQ. Good trading is about, it's up here. I can teach you the setups in 30 minutes, right? But it's consistent application in different kinds of markets, knowing yourself, that makes the big difference, at least from where I sit. So anyways, EQ is get good at decisions, decision-making in the face of uncertainty. You can't know the future. You can't stress about the future. It's a waste of time to worry about the future. You have to fully assess the now. And I'll get off this slide. I'm kind of rolling here, but it was such a aha moment for me when I finally figured out what it meant when people said, you don't need to know what the future holds to make money. You just have to fully assess the now, know your game plan, know your approach. And just as long as you take care of today, the markets are going to take care of themselves. All right. Have backup plans always. And when you make a mistake, fine. See if you actually made a mistake. You have a couple losing trades. So what? It's part of trading. Move on. Don't dwell. So consistency, game plan, I think I beat that to death. So number one, or actually we just hit number one, know yourself. Number two, know your stock. All right. So let's look at Nvidia. Super focused Nvidia. What kind of trader are you? What's your intended holding period? And are you comfortable with the risk required for that holding period? So this is Nvidia. Now, I've been out of sort of this teaching educational space for about 2 or 3 years. I went away. My research business, trading analysis, continued to be run by my team. I've got a team of 8 now at trading analysis. So I stepped away for about 2 years and I focused fully on wealth management. I went with a company, a billion-dollar wealth management shop. And I thought they were going to sort of absorb my research business, and pandemic hit and that deal fell apart. So I came back. So point is, I've been away for a long kind of period of time. So this is the first sort of educational webinar training class that I've done in like 3 years. So anyways, I first did this presentation for the first time in October of 23 last year. And I left it in because NVIDIA is super, super interesting. So this is from like October. So it's, 4 or 5 months ago, but I think it's really relevant still to what's happening today with NVIDIA. So I left it in. So NVIDIA back in October was trading 424, and the APTR, I really like this indicator, both when I'm trading options or the underlying stock. I like to see what the average percent true range is, the realized vol for the stock. On the weekly chart, NVIDIA 14 period APTR was 9.07%, which is $38, higher or lower. Expected move, that's been the realized move on NVIDIA Weekly. So if you want to buy the little pullback in NVIDIA at 424 on the weekly chart, it's realized about a 9% range, higher or lower over the last 14 weeks on average. Can you handle, a move down $38 to 386? Can you hang into that? Do you have the mentality for that? Do you have the account size for that? And if you do sit through that $38 drop, which is well within the average, range for Nvidia, can you sit up to 501, which is double the weekly APTR to justify the risk you had to take it? Can you sit through that? Right? And if you think about this, I left it in because, guys and girls and ladies and gentlemen, what was the hugest, most crazy range resistance level in Nvidia since October of 23? $500. What happens when it finally broke $500? The freaking market went crazy on the top side. So it's so relevant because I won't jump ahead, but let's just keep going. All right. So if you wanted to buy call options in Nvidia, and again, this is in October, let's say Nvidia's trading 424. So you're buying slightly out of the money. Let's say 430 calls are trading for $16. So 16 times your 100 multiplier, $1,600 in an option premium. Okay. So 430 call premium, 1630, $1,600. Break even is going to be your strike plus premium paid, right? So it's 430 we're considering. We're going to pay $16 for it. So break even is 446 at expiration. Remember, one weekly APTR is 38. So just to get to break even on this trade, you have to realize half of the weekly APTR. Are you comfortable with this emotionally and financially? And remember, these options, I was just looking out 23 days. If Nvidia consolidates, there's a good chance we can lose 3/4 or more of that $1,600 in option premium we laid out. Is this acceptable? And I left this example in because this is exactly what Nvidia did multiple times until it finally broke out of 500. So, for me, I would never risk more than 5% of my account on any single trade. So 1,630 of premium is 5% of 32,000. Do you have an account size that's appropriate to buy a 23-day, mostly at the money call option? If not, then either pass in the trade, maybe trade a smaller time frame, or create a spread. Okay. And this is kind of basic for those of you who are like 3s and 4s. I think 2s, you probably have an idea, but 1s, I think this helps. So I'm just starting basic here, and I'm watching my clock. I know Dave keeps this under a tight leash, but I'm moving pretty quick. All right. So let's say instead of risking that whole 1630 premium, let's say we bought a slightly out of money call spread. And this is where it starts, I think, to get good. And I think this is where we have a real edge. So if you opted for a call spread and went slightly out of the money, okay, now they say never buy out of the money options, right? I agree with that, but there are times when you do want to do it. I don't buy out of the money straight calls. You want to spread it out, and you want to have a plan as to when to do so. Okay. So, and I'll show you. So let's say you bought the 440, 470 call spread, $30 spread. That would cost $7.85. So $785 is the premium paid. It's a $30 call spread minus $7.85. So your potential reward is $22. Risking $7.80 to make $22. Okay, looking a little bit better. So if we just compare these two, right? Let's think about this. If we bought the 430 calls, 1,600 at risk, break even 446. And the profit on the trade, if we get up to 470, right, is $2,397 for a 0.68 to 1 risk to reward. If we did the 440, 470, risk is $785 as compared to 1,630. Break even is still the same, 446, 447. Your profit at 470 on the underlying is $2,200, where this is $2,400, pretty much the same. And your risk to reward goes from 0.35 to 1 risk to reward compared to 0.68 to 1. Obviously, this is going to be a much better strategy, but the key is, how do you know when to buy out of the money spreads? You'll never see me buy out of the money calls straight. Spread it out? Absolutely. Absolutely. I think it's a good, effective strategy. Okay. Yeah, but Todd, what if the stock went all the way to 500 in the next 2 weeks? Maybe, but remember, that'd be 2 weeks in a row of the stock closing at the top end of the weekly APTR. Not likely. You're trading with the odds against you. Clearly, the spread's the way to go. All right, so let's look at this. Now, what are you guys trading on? Are you guys trading on TOS, or what options platform are you guys generally using? Because obviously this is all built in TOS. And okay, so there's some good info in there. I mean, deltas you guys all should know, but the 470 on that option series we were talking about, those are a delta 19. And there's a couple different ways to look at delta. Delta means, if you have that option, it's going to act, they say 19% of stock, or if the underlying goes up $1, your options will go up 19 cents. Another way to use delta is to say that essentially the option market makers and the options pricing models are saying you have a 19% chance of the 470 calls seeing the light of day 23 days from now. And then you also have the probability OTM, probability out of the money, slightly different calculation, but it's saying there's an 84% chance that these 470s don't see the light of day before expiration. Okay. So if you think about it, all right, the market's telling us we only have a 20% chance of success to get to 470, but that's our ultimate target. So if you want to buy some options, and not spread it out, like your hurdle for profit is high, the market's telling you don't have a very good chance of getting up, much above 470 or 480. And plus, we know what happened with the benefit of hindsight with Nvidia. I mean, it was just crazy range below 500. Okay, so let's talk about the underlying market. When do you want to get directional? When do you want to get what I call correctional? There's two kinds of options trades that you want to be putting on. Ones that benefit from a market that's moving or trending up or down, or options that make money when the market is range bound. Okay, this is key. Here's the truest thing I think you as an option trader need to take away. Options are not an excuse, or options are not an excuse for you to understand at least what's happening in the underlying market. Options only enhance your ability or inability to trade the underlying market. If you don't understand what's going on in the underlying market, you're not going to be a successful options trader. Options only enhance your ability or inability, or highlight your ability or inability to understand and assess the underlying market environment. If you can be an option trader where you're comfortable buying premium in the right conditions, and an option trader where you're comfortable selling, being short theta in the right market conditions, that makes you pretty deadly, right? But if you have no idea what's going on in the underlying market, you're not going to make money. I promise you. Okay, so it's all about understanding when markets are trending and when markets are in corrective mode. And obviously, if you can identify markets that are in corrective mode, selling options is a much better strategy. The theta that you can collect, especially in higher implied vol markets, very good. Celsius is one that I traded a lot last year, and I have an option trade on now. If I have time, I'll show you. And Celsius, I've been doing diagonals on this pullback in Celsius, thinking we're about to go into another trending wave. In fact, I wish I had a Celsius, another one right now, but that's okay. Things are great. So your mission as a trader is just simply identify the trend. If it's up, buy short-term pullbacks in anticipation of trend resumption. If it's down, short near-term rallies in anticipation of downtrend resumption, right? That's the simplest way to break down your mission statement as a trader. So the beauty and the study, at least from my point of view, comes in when you start to understand how corrections in a market behave, what are their tendencies, and once the corrections are over, how far the trend waves may go. And we do that by using fib studies. I love fib. I don't know if it actually uncovers a voodoo, underlying order in the market that the eye can't see, or if enough people watch it that, these moves actually respect the fib levels, or if it's just markets have tendencies, and the depth of corrections and prior trend waves do have an impact on future corrective and trend waves. You want to know the stock's personality that you're trading. Okay, so the first tool, everybody knows fib retracements, and my joke that I put out there is like 61.8% of you out there probably don't believe in fib, and 38.2% of you do believe in fib, and that's fine. And usually I think it's a chuckle, but so retracements are probably what you're familiar with, and they're great. Retracements are used to figure out how far a correction may go to get on board the next trend. Projections are really, really handy. They're a little bit more advanced, but what you're doing is you're studying how far the prior trend wave went in terms of percent, and then projecting up, once we move into the next trend wave, how far that trend wave may go. All right. And I'll break it down. So these are your key fib levels. Okay. And again, what we're doing, and I'll show you how to do this, but you're studying the distance of this blue trend wave and projecting it up once you think the correction's over, how far this trend wave may go. Can you see how this might be really helpful when you're trying to figure out where markets might go in terms of strike selection and also time expiration selection? So it's a 3-click process. All right. So you want to have a known distance of a first trend wave. And I can show you how to do this on TOS, but you click the beginning of the trend wave, the end of the trend wave, and you click a third time. So it's a 3-click process, and then your fib projections will unfold. These will identify your upside targets for your trades. You're trying to find potential ending zone of your trend wave. Okay. Meta, this was August, September, October. Meta, beautiful uptrend, nice correction. So you click 3 times, once, twice, 3. And these were your upside projections in Meta. Clearly we're through those, but we did respect them on the way up. Nvidia, here's another one. Okay. So October up to the 500, we went back down to 450. So the way you do that is you click the beginning of the trend wave, the end of the trend wave, and then a third time at the end of the correction. Then your targets will unfold. So what was interesting is I'm going to offer you a training class at the end of this, where I did a 10-part option training course. And I actually put about 15 or 20 trades on in the course. And this was one of them. And Nvidia had pulled back, and I was looking for 100% projection. So what that means is if you click once, twice here from the October to November move up in Nvidia, that percent distance traveled is the same at 561, because we thought the correction's over. Maybe Nvidia is finally going to break 500. 100% projection was at 561. So I put a trade on, and I just did it live. So Nvidia trading at 494. We know if this is a real trend wave, the foundation, or the basis, of the minimum upside target should be the length of the prior trend wave. You'll be shocked how many times that happens in the market. Equal percent moves. So this is one of those times. I'm showing you the very beginnings of phase 1 of the 2-phase option progression. So I bought 8 of the 26 Jan, 550, 570 call spread, $20 spread. It was only trading, the spread was only trading for $2.60, right? Now, why would I do 550, 570? Well, the 100% projection was at 560. So $20 spread cost $2.60. Well, I just captured this chart for you about an hour ago. And yeah, we went right to the 100%. We hung around there for a day or two and then said, peace out, boom. Then we went up to the 1618 projection, hung there for 1, 2, 3, 4, 5, 6, 7 days before we said, peace out, boom. Then we just gapped above the 200%. So, I mean, I've got some options on now with our research clients. I've got some short-term, what do we have? I've got some short-term, I've got some 700, 710 call spreads. I've got some 680 calls. I'm long stock, just kind of waiting for Nvidia to finally make this move and just trying to break above the 710 mark, right? Well, what do you think the target is? Right there. So if I cap out at 710, I'm now in phase 2. Again, I haven't taught you anything yet, but you know, the idea of getting on board early in the trend, buying out of the money call spreads is phase 1. And I'll teach you the specifics in a second. And then phase 2 is as the trend progresses. Okay. So back to that original trade that I did in the course, bought 550, sold 570. I spent $2,080 for premium. So that was my risk. Max profit was $13,902. Here's the execution. So I bought them at 260 on December 19th and sold them for 1241 and 1740. I mean, that's a home run trade. It doesn't always work that way. Doesn't, I promise. But, you know, that's a, I don't know, $11, $12, $13,000 trade on Nvidia, risking $2,000, which if the trade didn't work, we have contingency plans, which the 2080 that I put out in premium probably could have managed it at down 1,500 or down 1,400. So, you know, potentially you call that a 10-to-1 reward to risk ratio. Okay. And being that this is the kind of market environment we're in, these trades are out there. These trades are out there right now. Okay. So the key is, as I mentioned, is good question here. And I'll jump into this is a transitional point. Let me just check my time. 33. Okay. Delta is the chance not to get to the strike. So is opposite of volatility. No. The first part is yes. Delta is delta is the probability that roughly that option will go in the money. So it's not, but it doesn't, I mean, it has an impact on volatility, but it's not opposite of volatility. Opposite of probability. Yeah. Right. So there's on toss, there's a probability ITM, which is in the money. So that will be, you know, you take 100%, subtract that from the probability ITM, and that will be OTM. So on toss, there's in the money, out of the money, and you're going to see that's roughly delta is going to be the same as probability in the money. So delta will be the same as roughly the same as probability in the money. That makes sense. So I really think, guys, that the key to success, at least from where I sit, is understanding the corrections. Now, I am an Elliott wave guy. I understand it gets a bad name because people don't like the subjectivity of it. And there's a lot of doom and gloomers out there, but it's a whole nother discussion. I strongly disagree. It's actually one of the most bullish methodologies out there because it tracks human collective progress as measured through our equity prices. And I think generally, despite all the doom and gloom out there, we're doing pretty damn well as a society, and as globalization is, you know, expanded and it's kind of come in a little bit. But you know how we're doing, you know, how civilization is doing. The scorecard is measured on our equity and our GDP. Equity markets and GDP and outcome. And, you know, generally it's up sloping, and Elliott wave is tracking that. Right. So at the largest degree of trend, you know, if you know Elliott wave at all, there will be at a highest degree of trend, there will be a completion of a 5-wave move, and it's all over. Either, you know, AI and robots take over, or a comet hits or something, but whatever, long conversation, but you don't need to overcomplicate it. And I think, as I said earlier, the key is understanding the corrections, understanding Are you in a market that is sort of range bound and correcting? How much longer might it last? And once the correction plays out and you have an idea that we might be going into a new trend, you want to shift option trading tactics quickly, and you want to get more directional, and you want to structure more, skewed reward to risk ratio trades in your favor, right? But if we're range bound, you go into income mode, theta positive, calm down a little bit, realize what's happening in the underlying market. And that's why it's so important to understand how your stock fits in what's going on in the stock market. It's so important you understand what your stock's doing relative to its industry, its sector, where sector rotation is, what macro influences are affecting your stock. Like, you have to be responsible for this stuff. You want to make millions, you've got to put the work in. It's not 2 or 3 indicators I can put in front of you and say you're going to make money. I'm wasting your time. You're wasting your own time. You're wasting your money. I have too much respect for this game, and I have lovingly dedicated my whole life to this. And anybody I work with, I require that they have that same level of respect for this business. Too many people just throwing 2 indicators on your charts and say you'll make money. That's what I hate about this business. Okay, so one of the corrections I like to introduce you to. So flat, zigzag, and triangle, right? So the simplest but most effective, important, and sadistic correction out there in the market is the zigzag. And it's this. It's down, up, down. So you'll have a preceding uptrend. Never buy the first pullback, okay? Because usually what the market likes to do is suck the pullback buyers in. Maybe they pull back the moving average or support, or your indicators oversold. And here's the first pullback. People get involved and they're like, oh, awesome, I bought the pullback. And then the market does this, boom, reverses back, stops you out below these lows. You get mad, throw your hands in the air, say this market's dumb, it's never going up. And that's when it rips. Right. So it's the most basic, simple way for the market to shake out as many participants, trend following participants, as possible before it ultimately goes where it's headed. All right. So here's where we can use a little fib on this false break in B. Here's where you pull out your fib retracements. So look for a failure between about half back, which is 50%, 618. And I think there's a lot of stop run moves that happen. And I see the stop runs through 618 that exhaust themselves at the 786. So again, if this is a $10 drop, watch the pullback to $5, a $6 rally, $7 to $8 rally. That's going to be your fib retracements. Watch for the drop. Watch for sentiment and bearishness to kick up. Watch for a little volume exhaustion down here. And that's when you're looking for the ABC zigzag to complete. That is a great buying opportunity. Okay. Now, you can also use fib projections here if you really want to fine tune your 3-wave pullback here. So you can use fib projections where you go distance traveled here is a lot of times equal to distance traveled here, right? So if this was a 4% drop, you get the B wave false break, look for another 4% drop. And again, TOS and everything has those fib projections in there. Augs, thanks very much. 698. Okay. It's just been messing around. It's kind of quiet today. No real data, no real earnings. It's a little quiet. Busy earnings last night, but market's a little uninspired. So, so this was, there's ways you can trade these zigzags. When I first put on this presentation, this was the NASDAQ. I was thinking that this is a false break. Remember I showed you the B wave right here? So this was September. I was getting ready to do this presentation for the first time in 3 years. And I was like, I think we're going to do this is a false break here in September, October. And I had shorts on. And listen, I have a lot of long stock, so I'm hedging it. So it's not like an outright short, but I was hedging my long positions. I had some put spreads in NDX and QQQ. These are the guys right here, thinking that we're going to get a push down into the typical A, B, C support zone that I just showed you here, A, B, C. Well, we got it. And I was looking for the Qs to get down to 350, 340. The day I was doing the presentation, for the first time, again, this is like my I haven't done a presentation in years, and it moved down, you know, the market moved down into the lows here, and it was oh, I have the S&P chart here, but anyways, this was where's the date on this? So this was September 27th right there, 9/27. So I took off the NASDAQ and the Qs, made, you know, $14,000 or whatever. And again, these are hedges, so it's not like it's just pure profit. I was losing money on my long stock position, but you know, I bought it on September 27th, which is going to be, you know, somewhere in there. I thought that was the low. I was like, oh man, we just nailed it. So there's the Qs right there. So down, false break B, boom, really good anticipated zone of support. I'm like, man, I'm just going to own it. So I was like, I'm going to buy the shorts back and take profits. And if it's the low, man, you guys will probably never hear the end of it again, because I'll never stop talking about it. But what happened was we rallied up, and then the market did a pretty sick and twisted thing. It made another, actually did another zigzag down. So that's when I covered it, rallied up, then went down into October, end of October, and then it rallied up. So, and then here we are now, you know, at new highs in the NASDAQ. And I'll tell you what, this is a critical juncture. Again, I'm an Elliott wave guy, and the most obvious, simple count may be in effect right now, because coming from all of 23, we've got 1, 2, 3, that pullback I just took you through in 4, and now we are up here. Now we may be at a 5-wave move. I have a hard time seeing the market pull back based on what the expectation is based on wave theory. It's not everything that I do, but the pattern is there. So we might need to get aggressive. I mean, the pattern is clear in Amazon, it's clear in Microsoft, it's clear in NASDAQ. There's a lot of 5-wave moves up there, so we got to watch. Okay, so how am I doing? Is this making sense? Am I going too fast? I'm trying to fit this in really quickly. How are you guys doing? Are you awake? Is this helpful at all, or is this a waste of time? Okay, so yeah, baby, trade the waves. All right, so this was a very interesting point into Q4. The zigzag that I was showing you, here are the rules on a zigzag, the guidelines, ABC. It was really a pretty amazing time, because the markets, the sentiment was really bearish. I mean, people are saying we're going into recession and sell all your stocks. I'm like, guys, I don't see it. I see an ABC correction. Netflix, ABC correction, zigzag. Microsoft, A, B. This guy could only get to the 618 of A versus C. Netflix tried to hold 618, 618, broke, almost got down to 100%. And again, percent distance traveled in A versus C. Okay. So Apple, oh, sorry, this was Apple. I don't know why I said Netflix. This is Apple. A, B, C. Oh yeah, Netflix. Sorry. Let me start again. A, B, C, and Netflix. 200-day, 100%. Interesting. Here's Microsoft. A, B. Can only get to the 618 Microsoft. So that's showing you that there's some relative strength there in Microsoft. Apple is A, B. Tried to hold the 618, 618, 618, pop below, right down in the 100%. Patrick Industries, I like this stock. This thing's a thinner, lesser known stock, but this thing really moves. Held 100%, went up to 618, broke 100%, went down to the moving averages, and then popped back above. That one was nasty. Comcast, A, B, C into the 618. Beazer Homes, this was like a amazing pullback buy in Beazer. A, B into the 618, C versus A. XLK itself, the technology ETF, A, false break in B, right down into uptrending 50-day moving average, 100% projection. Like, that was it. That was it. So let's pull it together. Okay, we talked about understanding the trends, understanding the corrections. I showed you the zigzag. I showed you how to measure the legs of a zigzag. And let me see here. Is there any chart? Give me a chart that you guys want to take a look at. Maybe I can give you a, oh, that's a mess right now. See if I can show you how to do a projection. Okay, let's take a look at Tesla's a mess. All right. All right, let's do Tesla. So what you do is you go over here to this guy right here. Thinkorswim mistakenly labels it extensions right here. It's projections. I asked them to change it a while ago. They never did. But okay, so what you do is you click the beginning of a trend wave. So you click once, click twice, you click a third time. 100%. Almost, actually. Yeah, almost tested 100%. And then you could do it again. There's another trend wave here. Down, click a second time. Guys, I mean, like, I didn't even plan this. I legit didn't plan. I just looked at the first symbols. Like, let's check out Tesla. I mean, you had this was equal to this. This was equal to this. Like, okay. Jeff, I'm not going anywhere near that comment. All right, let me get going. And oh God, I got to move. All right, phase one. Okay, so here's what we're going to do. We're going to move. Here's your CDS, phase one trade plan. Okay, I got to go quick. Do a fib retracement of the entire ABC correction, Microsoft. Okay, so you do fib retracement of the entire ABC correction. Find 50 to 786. Step 2, 3, 4, and 5. I'm going to go through it all. All right, so here's Microsoft. Step 1. You know we have an ABC correction in Microsoft. Do a retracement of the entire ABC correction. So you click the top, you click the bottom. All right, and I'll show you how to do that quick. So for instance, here in Tesla, it would be over here. You go like this, retracement. All right, I would do it from here, A, B, C. So you click the beginning to the end. I'm going to get rid of that 100% projection just for clarity. All right, so 50 to 786, 227 to 257. That is your first objective right here. Number 2, you look for expirations that are 2/3 the distance of the time elapsed in the ABC correction. In Microsoft, the top was in July. We went down into late September. It was 51 days. Take 2/3 of that, 33 days. Your expiration is 33 days out. If you're trading a market that is highly bearish, it just went down, up, stopped a lot of people off. There's a lot of pessimism, vols up, people are getting stopped out. If this trade works, you don't need that much time. That's why we go 2/3 the duration of the correction, because if it works, it's going to work pretty quick. You don't need to buy too much time. Structure a call debit spread that buys the option at the 50% retracement, sells the option at the 786 retracement. This is what I call the retracement of last resort. There are so many false breaks through 618, stop run through, and there's so many false break reversals that happen at the 786. It's amazing. Again, whether it's uncovering some natural order in the market or if it's just, you know, the big algos are running stops through 618, and by the time they're done in 786, probably some combination of the two. But you want to try to get up to the decision point. This is the retracement last resort. This is the decision point, whether the market is likely to continue higher or this is a false break, and we're going to do that. Tesla basically did that here, right? Look. Oh, shit. A, B, C. Okay, is this it? Are we going to go to new highs? Well, let's do a retracement. Where did it fail? Where did it fail? $786. Okay. So structure a call debit spread that goes 50 to 786. If it doesn't work right now, I'll show you how to get out of this trade. We're going to exit. We're gonna manage risk. Okay. 51 days, 2/3. We're going 33 days out. There's options that are 29 or 36 days, shade a little bit more, which is fine. So we're going 36 days out, 3 noves. Remember, we're buying the 50% retracement, selling the 786 retracement. That's 335, 355. 338, 354 are our numbers. Closest that we have are 335, 355, 33 days out. This is a phase 1 CDS trade plan. All right. So here it is, 3 noves. And I did this live in the class as well that I'm going to offer for you. 335. And I have losing trades too. Trust me, I'm showing you a couple winning trades. I've got losing trades that I happily take, but the losses are smaller. And that's what you have to pride yourself on it. I'm showing you some winning trades. I happily take losing trades in the course I'm going to offer you, and I'll show you how to do it. And I don't care. I've been doing this long enough. I know I'm following my plan. You're going to have losing trades. So anyways, we did 335, 355, 283, 283 bucks is max loss for one spread. 1717 is max profit for one spread. And as I said, if trade doesn't work pretty soon, we can cut it. We might be able to keep 150 or might lose 150, $200 of the 280 that we're risking. You know, it depends on your risk management. All right. And we're going to hold until 786 retracement is tested. So I did it. And this is a screenshot from the class. Put it on. You could check it out if you want. I'm just watching my time here. We started to move up. Remember, we're trying to get to 355. That is the 786 retracement of the July to October drop. Notice what's happening. APTR, realized volatility is doing nothing where IV is going up. Why would IV go up in an uptrending market where realized vol is going nowhere? Earnings. So earnings came out in Microsoft on October 31st. Remember, we're trying to get to 355. Earnings were solid. It spiked up to 351 after hours. Can't trade options after hours. So I sent out an email to our subscribers like, all right, let's take half off. Sold half at 747. So in at 285, out at 747. Sold the rest at 18 and the 17 and $18 on this. So 2 examples of out of the money CDS, call debit spreads, phase 1, trading up to the retracement of last resort. That's trading with a plan. Phase 2, and again, I'm going super fast. What I just put you in front of is at the end of an ABC correction where the market is very oversold. A lot of bearishness, just like July, August, September, October. This is where you can do some high reward, low risk trades. Probability is not huge of success, right? You got to manage these. But when you hit them, the reward is multiples the risk. Once you're up here, here's where things change a little bit. This is a phase 2, cat's out of the bag, trends in place. You know, markets are a little bit more hip as to what's happening. You got to shift tactics, and you're going to go into a lot more choppy phases right here. This is loose Elliott wave, but you know, if you can understand the progression and where you are in the trend, your option trading tactics, your risk to reward are going to change. Okay. This is an example. So here's the NASDAQ down into the end of 23. We traded this as I just showed you. Then, you know, as we rounded the new year, January, February, we were kind of range bound in the market, right? And we're now pressing highs. So here's a good time to do less Vega. You want to have, right? You don't want to have so much theta. You want to have less Vega. You want to be, your risk rewards aren't going to be so skewed in your favor, but your probability of success is going to increase up in the phase 2 area. I like doing broken wing butterflies. I like doing straight butterflies. You know, you can do some credit spreads. You know, it's a different shift up here. Okay. So here's Microsoft again. You know, we traded that up to the 786. Then we put a phase 2 trade on. I did a 380 or 360, 380, 400 call fly. Once we started moving into the latter parts of this move, It's a phase 2 tactics change. Got up to the target, which I'm not even getting into, the 1272. But basically, here's the math real quick. I'm just trying to, I don't want to go over, I want to be respectful of other people's time. But 786 retracement, remember I showed you that? 618, everyone knows. You square root that, take the square root, 0.786. You do 1.618, take the square root, it's 1272. There is so many times that I've seen a move that does not reverse at the retracement of last resort, which is 786, that goes to the 1272. It's such a good relationship. So that is the foundation of the phase 2 butterfly into the 380, because we're trying to get up to the 1272. We got up to 1272. I didn't do anything. I didn't manage this trade well. Backed off. Ultimately got out of this one December 8th and paid 589 and was selling them at 13 and on the body of the butterfly, but that was the total result on the trade. Oops, that was a drum. I really didn't even mean, I just hit D on my keyboard. I didn't even know that works. Let me try that again. Oh, that's awesome. I didn't know you could do that. That's pretty cool. All right, keep going. So later, phase 2, trying to get up to 403, blah, blah, blah. Keep going, phase 2. So, guys, I think I showed you really, really quickly that you have to have a game plan and understanding of what's happening in the underlying market. Earlier in September, October, November, we were doing out of the money phase 1 trades, high reward, lower risk, lower probability of success. Phase 2 is the market's moving higher as we're into this possible 5-wave move. We were doing more butterflies, call butterflies on the upside, which is a better way to, manage risk a little bit and not such an aggressive, expression of wanting to be long. So it's understanding what's happening in the underlying market, I think, is the key to success as an options trader. So as I said, I came out of sort of retirement for the research and the education side. I was focused on money management. I do money management. I do option spreads in the money management. We hedge portfolios all the time. I teach you how to do it. So if something you're interested in is a 10-part course, 10 key lessons that we take you through, but there's also a lot of extra additional time spent on research, live trading, and I have over 15 live trades with the Real Capital, TradeOutLoud.com/buy if you'd like to get involved. So, for me, formula of success is prep. I'm going on this trip in 2 weeks. I'm like 45 now. This was 2 years ago. I can tell you there was a lot of prep that went into this before